risk arbitrage. So look, I think this is an industry where you have a ton of very smart people. So I thought before we even did the panel, I would send out some questions or try and get some potential questions from some people in your industry. So I asked, what should I ask Howard and Mike? And the questions I got back were, will the Chinese approve Mellanox? Will California sue to block T-Mo Sprint? And can you ask Ed who his source was for such and such a deal? So I think we can discount all of those for now and move on with the topic. So look, the name of this panel is Alpha in the Age of Information Overload, which the three of us have talked about this over a period of time, that we are now in this environment where you have so much information, so many different sources of information, and everyone kind of has access to the same stuff. There's very little sort of high premium information that only the few can get to. What I'm interested in is, how do you continue to generate sort of above market returns in that environment? Howard, I'll start with you.
Well, I think you got to start out with a general principle, which is that we're always evaluating not just content, but the reliability of the source. We don't have the luxury of people who are like following politics, who might just say, hey, I want the New York Times or I want Fox because of my opinion. We're looking at the facts. Ultimately, you have to have a discrepant opinion of the facts if you're going to earn above average returns. And you can't accept consensus. I think that's the biggest danger to an ARB. It always has been, but now when things are really squeezed, that's especially so. So you have to look at the facts and say, hey, do they square with my philosophy of the trade? Does this make sense? So as an example, when there's a regulatory issue still open and you have 30 or 40% downside, and you only have 1 or 2% to make, you have to really look at that quite critically.
Mm-hmm. Yeah, I mean, I would totally agree with what Howard said. And I would also add, the question that you asked seemed like it was aimed at the fact that, given that there's so many news sources now, there's a proliferation of news sources, and I look at it as almost an opportunity in that, tweets move spreads, which is shocking, but they do.
Even ones that are from like unknown sources.
Right, and so I think, in my experience for the last 5 years with that increase of news flow, I think there's a lot of opportunity to generate alpha trading spreads around. So I look at that increase in news flow as an opportunity in order to trade around a spread.
But how do you stay on top of it? Because as I say, the quantity is enormous. And, let's say, I don't know, like 1 in 50 times, one of those random tweets turns out to be bang on, and there's actually a huge opportunity the other way.
I guess for me, it's probably how an allocator looks at an investment manager. I mean, is there a strong, repeatable process behind that reporter or that publication? And so that's the way I look at it. Clearly, sometimes reporters may be wrong, and they may be wrong because they were right. And what I mean by that is, you put out a story and the acquirer's stock goes down by 15%. That deal might not be announced. But if there is process and there's a history of success, it's a lot better than, the person in his bedroom chasing, rumors. So that's my point around process. I think it's really important.
It's always interesting to me that like anonymous tweeters are always in their bedroom. They're never in any other room in the house. So Howard, another sort of big aspect of the risk arb market is, and this is as I see it from the seat as a journalist, which is an interesting seat to see it because obviously we all kind of get to know one another by one side calling the other to talk about a particular deal or to try and get some color, and it's always color or checks that we're interested in. But one element is interesting to me about arbitrage. It's so human. It's so individual in terms of the decision making. Yes, you have a lot of groupthink and consensus around ideas, but ultimately it's down to like the individual PMs in terms of how they calculate the risk and how they deal with the information they have. At the same time, the hedge fund industry more generally is moving much more towards algorithms, robotic trading, et cetera. That's not just a media fascination, that is real. Where does risk arb sit on that spectrum, and how much of it can be, I suppose, computerized?
I mean, I think sort of, if you look at everything that's going on in the world, we always underestimate how you can be replaced or how an investment strategy can be replicated. And I think you sort of, it's pretty arrogant to think that we're in a niche that is the only niche in the world that can't happen. But one thing we always keep in mind is that even though there are hundreds of deals a year of size, they're each very different. And so if you immediately say, hey, there are 10 big industries, each of which I'm simplifying here, but like each are 10%, well, that already makes it difficult to model everything the same way. Then if there's cash versus stock, those are different. If there are LBO agreements versus standard corporate strategic type transactions, they're very different. So it's not as easy to model as you might think. And when you do model it, and a lot of people do, you start accepting consensus by definition. So what will happen is you'll have spreads come in, especially as interest rates go down, and people will be saying, hey, I've got this algorithm and I can outperform treasuries by 300-400 basis points. And guess what? Like when all hell breaks loose, you're short of put on the market. You really are, because those things are going to go south, especially the private equity deals. Some of them will break. And you can accept a lot of terrible transactions. In the end, I always joke around, like, a lot of these things have turned out really well for ARBs, like AOL, Time Warner, like Countrywide, like ABN AMRO. I mean, ABN AMRO went into a merger with Royal Bank, and 6 months later went into a merger with the British government. So involuntarily. So there's a lot of consensus thinking that is terrible, and a model will try to replicate consensus thinking.
Mike, I want you to sort of pick up on the same thing, but also to, I suppose, talk about, in your experience of doing these things, how do you get away from what Howard is talking about? How do you actually differentiate from the groupthink? Because it is very powerful in the industry, and the same ideas do get kind of kicked round and around in a circle, and often my industry ends up picking them up and running with them, which can sort of add to the proliferation. So how do you step away from that and say, all right, I'm going to think about this in a way that is different?
Right. To Howard's point, I mean, I think in the arbitrage space right now, it's almost bifurcated in that there are quote unquote safe deals that trade at very tight spreads, maybe 0 to 2%, 97-98% implied odds of closing. And then there's the other that will have some complexity and sometimes a lot of complexity. To your question about algorithms, I believe that the safer deals is easier, to Howard's point, about for algorithms to invest in, and they use leverage. And I think you see the backfire of a strategy like that with algorithms when you look at something like Newmont Mining and Goldcorp. That was trading at 10 basis points. 10 basis points. And John Thorne came in with a hostile bid for Newmont, and it blew out to 10% gross. And so I think there's opportunity because of algorithms in an example like that. I also think, when you're talking about merger arb, in the merger process itself, I mean, there are people making decisions on both sides of the coin there. And so there's a humanistic element, I think, that is more so in complex deals. And I think it's tougher for algorithms to nail down the personality of a Vicky Holub or a Michael Neidorf at Centene or John Thorne, which I mentioned.
Right, and that's actually a really good point, because a human could have potentially said, based on Thornton's track record, that it wasn't going to sit easy with him that he was now going to be the second biggest miner in the world. And so ego would dictate that maybe he would come in and bust out, but I'm not sure an algo is able to process that in the same way. They may be able to look at track record and make some kind of calculation, but it's a very interesting point. So on the question of sort of the way a lot of these deals are trading, and you talk about some spreads trading, inside 1%. Others, we do have this bifurcation. And it seems like it's deals either trade sort of wide in a way that isn't necessarily easy to explain, or they trade so tight that there's no real upside in the deal. So when they are trading very wide, when we see these deals like Centene Wellcare that was way out, and like some other recent examples, are you looking at that as an opportunity and saying the market is just not pricing this right because there's so much money in these tight spreads already?
Again, it depends. There are times when things are really up in the air for Sprint, for Sprint and T-Mobile, and people might have a strong opinion of them, but you've seen the spread go up and down. You could have made a living if you got it right, just
right,
on the vicissitudes.
10% moves on a story.
Yeah. Our, I guess, view is always, well, the spread dictates a certain risk reward, and do we have a view that's different from that risk reward? So if there's an implied likelihood of that transaction going ahead that's 50 or 60%, we think it's really 90, 95%. We have a lot of confidence in it. That's very attractive to us. But a lot of these things really are 50-50. They really are scary. And the classic is antitrust, where it's sort of like, we call it antitrust derby. Once you get to a point where it's very tight, it could be a 4-3, something which just experience tells you is dangerous. The job is to again have that kind of discrepant view.
I totally agree, and I think each situation is different. I mean, your job as an arbitrageur is to go through the risk and focus on the ones that you think matter. I mean, take Celgene and Bristol Myers. Really, the only thing that mattered when the spread was trading at $10 was, is Wellington going to come out? It wasn't really Starboard. Is Wellington going to come out? And that's, rumors about it and stories about it. And that spread went to $30. And it was implying a 33% chance the deal was going to go through after they came out. And obviously, ISS came out after that, and now it's trading around $2. So I feel like the ability to focus on what matters is really important in arbitrage.
How do you deal with the run that we have been through of sort of unprecedented events, whether it's DOJ coming out against T-Twix or Broadcom, Qualcomm, and we can talk about whether or not this was truly unprecedented, but the ruling in Delaware against Acorn, which obviously was the first MAC that had gone all the way through. How do you deal with that? And is that just sort of a factor of this environment and something that is potentially an opportunity?
Well, I think we've always had some really binary situations and some crazy things going on in the world or with respect to an industry. Today, it's a little more severe. And what I think is really important, when you're looking at the whole portfolio, to say, hey, how many of the transactions we're betting on have something to do with the China trade? And it's pretty scary if you look at it and you say, wow, 30-40% of our capital is in this thing. And if it really blows up and what is now a hot war becomes hotter or doesn't cease, that's that whole big part of the portfolio. Maybe there are better ways to express it than doing arbitrage.
Well, does that then mean that China becomes the sort of foundation of all the analysis around your trades?
That's right. You can do a lot of great work, but you're not in a room with Xi or.
And that's also a totally different skill set. That's not sort of economic arbitrage. That's geopolitical.
I think what's even better is the reality that no one has a skill set for that. You can hear a lot of guys pontificate, and if they can't figure out what's happening between two world leaders, then I don't know how you are as an Arb or as a banker.
Make an algo that can read Trump or predict his next move. Yeah. Mike, on this question about the unpredictability and what you were saying earlier, it does create these like violent moves in the spreads, and T-Mobile Sprint is a very good recent example. The way a lot of the Arb funds are structured, and correct me if this is completely wrong, it's if the shares move down too much, then you hit a risk limit and you have no choice but to at least trim or maybe exit the position. When you're seeing this huge volatility in the way these things trade, if something does trade down, let's say 10%, or the spread goes out 10%, and actually like fundamentally nothing has changed, it's just a news flow or whatever has dictated the move, how do you play that? Because you want to double down, but you can't necessarily.
I think you have to have a maniacal focus on your downside risk, and I think Arbs that have long longevities in this business, they clearly focus on what they're willing to lose if they're wrong, and they size that position accordingly. So, to your example with Chinese antitrust risk and NXPI, I think that spread probably moved at least 20 times up or down by 5%. And more. So I think there's a lot of opportunity trading Arbor spreads. And just on the point of we're in more of a severe uncertainty, and I agree with that. But I would also point out, if you walk down history lane, 2007, 2008, the great financial recession, there were deals that closed and there were deals that didn't close. Right. The strategic deals, Mars and Wrigley, partially funded by Buffett, closed. InBev, Anheuser-Busch, that closed. Sallie Mae, Huntsman, URI, private equity deals, levered transactions, levered banks providing that financing, they didn't close. We're talking about Trump now, but let's not forget in 2014, inversions. President Obama didn't like inversions. He made it pretty clear, and he told his Secretary of the Treasury to do something about it. They changed the rules.
Well, that raises a great point, actually, because one of the things that Arbs are famous for is trying to get information, and within legal bounds, and they hire all sorts of people to give them opinions on occasion. And the more you did work and looked at the contract, sort of for the nitty-gritty in an LBO contract, or the more you looked at the tax regs, you may say, "Oh, I found a way why it's going to happen."
Right.
And I used to tell people, "Hey, okay, the most powerful person on earth hates this deal. It's an inversion. He said he hates it. Like, why do you think you're going to overcome that with your work?" Or in an LBO, at the end of the day, most of them are written so that there's a break fee and that these people can walk.
Right.
And I don't think for a minute that they're going to do something charitable. It's not like endowing part of the Met or something. They don't want to give money to merger investors, and so they walked because there was a finite amount they could lose. Even that was often litigated, so they didn't even lose that much. But yeah, it really tells you how important it is to keep the central issue in focus and to understand whether that is something that can just kill you. I remember talking to a colleague and saying, "Hey, you're such a your long-short area so well. You're just a great stock picker." And she said, "I'm not a stock picker. I'm a great risk manager." And I think that's the most important thing of for anyone who's doing a hedge fund strategy, to be a risk manager first.
I think just to pick up on that point, which makes a lot of sense, is that a lot of ARBs, I feel, sometimes will get stuck in the four corners of the merger agreement. And to your point, it doesn't really matter when you have a company that wants to get out of a deal. And I think you asked the question before about the human elements of risk arb, and I think one of the biggest detriments if you are an arb is to have an ego in this business, because things change in arb spreads, and they change often. And if you have an ego and you can't admit you're wrong, or things might have changed, or you can't listen to other opinions that might allow you to retest your own thesis, that's a tricky spot to be in. So yeah, I agree.
I think the same would be true of an M&A journalist, or I hope it would. Look, ego is, and as you say, there is something sort of irreducibly human about arbitrage, and to some extent about M&A generally, because so many of the transactions we see today are driven by ego as much as anything else, by the need to be the biggest, or the need to do a deal because someone else in the space has done a deal. How do you factor that in? How important is it when you're thinking about M&A and you're thinking about spreads to understand the personalities involved, to understand whether it's the CEOs, the people on the board, or indeed the advisors, and how much sway they have?
Hugely. And we've been talking about several deals recently that were potential hostiles, and I said, well, it's more difficult to go against someone who's a founder, someone who's led the business for 20, 30 years. And if you're in that same industry, and typically CEOs in the same industry have a relationship, there's less of a propensity to want to fight them for their baby. Airgas is a classic example of someone who did that, was a very successful leader, brought all that value, and all of a sudden someone is there offering a 30% or whatever premium, and all the arbs are sitting in back of him saying, sell, 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 sell. and you have to be humble. They're not going to do it for us. You have to sort of change shoes and say, hey, how would you feel if you were the CEO? Is it reasonable if that person has already led 15 and 20% year-over-year growth in the stock price to then sell for 30%? And I don't think it's that reasonable all the time.
I think this sounds very millennial of me, but I think you're describing empathy. Like, I think ARBs need to have empathy. You need to be able to put yourself in someone else's shoes. You need to put yourself in making Doverheim's shoes. And what was he thinking with AT&T Time Warner? Was it political? You need to put yourself in the CEO's shoes, the chairman's shoes. It doesn't really matter what I think is the right outcome. It matters what he or she thinks is the right outcome.
Relating to both of your points on this, if the ARBs and to some extent the activists or the normal shareholders who are just being more vocal, that's a big part of the market right now, and everyone has this platform on which to speak and make their opinions known. Does that add to this sort of sense of hostility against the target companies, and therefore make them, I mean, to your example, Howard, of a founder who's built a business and grown it, if he has a lot of ARBs publicly out there saying we want this, this, and this, and potentially other shareholders, does that make him or her less likely to want to sell because they feel like the whole environment is hostile against them and you can't get a friendly deal done?
Wow, there are two things going on. I mean, it's always been the case that there are people in the markets who are going to, want to sell a family member up $1. That's just it's just the way it is. And there's pressure for us for short-term gains to do things like that. I think today you're not seeing as many hostile bids. They're difficult to actually.
You mean true hostiles? You mean
true hostiles.
Right.
Yeah,
because I think we sometimes are quite fluid with that.
Right.
term.
I mean, people give up. I mean, there's a lot of that happening.
Yep.
There's a lot of sort of saying, to be fair, wow, so much of our shareholder base is going to turn over. Mm-hmm. I may as well just start getting the parachutes ready because the writing's on the wall. This is a very big premium. Mm-hmm. Let's face it, we haven't brought value. We've been hearing a lot of complaints, and we're teed up. So there's a sort of a little bit of a mix. I think most CEOs don't want to sell their company. It's a gravy train when you're heading a large company.
You get a private jet. Yeah,
well,
you get to speak on panels.
Right. Exactly.
I think Arbs get a bad rap for this, and the truth is, I mean, Wellington came out against the Bristol deal. I mean, they owned Bristol. They didn't own any Celgene. I wonder if they came out because they wanted Bristol to be sold. And so, we get a bad rap for short-term gain, but I think, to your question, I think it matters more so what long-term fundamental shareholders want from the management team.
But playing devil's advocate on that point, someone would say, Wellington came out exactly because of this dynamic we have in the market, where shareholders, be they Arbs or activists, are putting pressure on companies all the time by airing their opinions, which is forcing other traditionally quiet shareholders to show that they too can generate alpha by speaking up. I want to talk about ISS and to some extent Glass Lewis and their role in all of this, because it's even in the short time I've been writing about mergers, it has grown exponentially. And we still think of them as being essentially advisors around governance, but it's become slightly bigger than that. Is that fair, Howard? Do you think that they've grown there, or there's been a creep of their remit?
I think it parallels the growth of passive and indexed management. So you have a large number of companies that have 30 and 40% shareholdings in the hands of just several groups, and they either are trying to show that they have the lowest management fees possible, so they don't have an infrastructure, or alternatively, they're saying, hey, our job is not to be active in the sense of even picking the stock, never mind influencing its policy. So we're just going to be safe, keep the SEC off our back. We're just going to automatically take what these services give to us. And the result to me is really horrendous. It's really frightening. It exaggerates the power of anyone who will speak up. And so it's an opportunity for the T. Rowe's or others who might do that. And it speaks to the dangers of accepting really bad deals. If you look back historically, the reason these shareholder services started to develop, these proxy advisors developed, was because there were kind of very thorny legal issues surrounding voting. You might say, hey, should they be able to do this transaction? It's not really fair because someone's getting higher compensation, or shareholders are being frozen out on this other issue. And now they're sort of actually making fundamental decisions. And just think about this. People are actually saying, hey, I want you to vote for this merger because it's really good for the company to issue 40% of your shares, and we believe the accretion estimates. Now, why do you own that company if you can't have a judgment as to whether that's good or not? If you're holding billions of dollars of stock in a company and you don't even have the resources to say, hey, it's worth voting for or against that transaction, it calls into question that whole model.
I would just add, I mean, I think if you believe that the asset management business is consolidating, and you look at things like Wellington putting out that press release, I personally believe that these capabilities they can obviously do. I think they'll start internalizing them, perhaps. If you asked me to give a guess of how important ISS, and by the way, I think ISS does good work, and I think they get to the right decision most of the time. Are they going to be able to control 25% of the vote of a company in 5 years, I think that might be difficult.
Right, but if they do good work, but if their work has gone beyond governance, if they're also advising, as you say, on more fundamental things, is there a case that they should be better regulated or regulated at all?
There's an argument for it, certainly. And there are also a lot of soft mechanisms, in markets for people to say, hey, what you're doing is dangerous if you're a $1 trillion firm and you're farming out that role. I just think to what happens almost every malady in the world is a consensus thing. Even racism is a consensus, right? And when it comes to voting about a fundamental transaction, the consensus could be deadly, like AOL. And if you're indexing everything, it reminds me about 20 years ago being approached by money managers, and they were saying, hey, we would like to take a big part of your portfolio and we're going to index it to the S&P. And the S&P was trading at over 30 times, over 30 times in 1999. And it was the S&P went down 50% without even a true economic catastrophe. So those kinds of things that are passive are often the most dangerous things in the markets. They're a form of soft corruption in a lot of ways.
As an industry, are you guys able to actually talk to, the semi-duopoly of ISS and Glass Lewis? Because it's always interesting to me, who actually influences them? Obviously, they listen to the likes of T. Rowe and Wellington, but do they also listen to the arbitrage community?
I personally think, if you think about it, the arbitrage community, by the nature of, being invested in the arbitrage spread, it's pretty obvious what way you want the transaction to go. So I think they do obviously listen to the arbitrage community, and the arbitrage community, has their services, but I think they obviously understand, or they try to understand, more of the view of the long-only community. So can we have an impact on ISS if we share our opinions with them? Sure, if they're good opinions. But I do think they try to focus more on the long-only community and coming out with the best guess of what they want to have.
Yeah. I also think there must be some selfish interest in sort of wanting to maintain the business or make it more relevant. And just like for managers, they want to be more relevant by being activists sometimes. And in that, it could be good things, but it could also be dangerous.
That's the point on which I want to end. Is really, as Mike said, we've seen this convergence in terms of strategies, whether it's sort of long-onlys becoming more like activists, or activists telling everyone they're actually really friendly and they're not like activists at all. Is that going to become a feature of sort of traditional risk arbitrage, where you see ARBs, taking event positions that then become more like activist positions? They actually come out with whether it's they come out with a kind of deck or a proposal, and if so, does that change the way that we as the media should actually think about the ARB community when they are taking big positions in companies?
They're a mix. A lot of us, for compliance reasons, because of where we are, might not ever be active. There are other people who are active, they might send a letter, but they're not going to make it public. Certainly, it is part of our world now, and sometimes it's great. There's an opportunity. There's a trade in it. Other times it's really horrendous, because it could be people with some market power in that transaction, and you say, hey, this looked all lined up, and now this is out of nowhere.
Right.
There are a few more meteors within transactions than there used to be.
I guess I would flip it around a little bit and say, I think the event-driven community and the activist community, I think sometimes, especially with deals like NXPI and Centene and WellCare, Bristol Myers and Celgene, I think they see how big gross spreads have gone. So I think the activist community may be more attracted in ARB spreads because of those, the size of the spreads that come about because of disruption.
That is a great point for us to end on. Michael, Howard, thank you so much.